from AGI Deductions. There are a variety of deductions from AGI. QBI is new. It was implemented with TICJA. It's never been done in the tax code before, and we're going to spend a little bit of time talking about QBI, which stands for Qualified Business Income, but there is a Qualified Business Income deduction. Personal exemptions have been suspended. Personal exemptions were part of the tax code all the way back in 1913 and have always been part of our tax code, but TICJA suspended those for tax years 2018 through 2025. Now, what a personal exemption is, it was an amount that you could deduct from AGI before you got to taxable income, which gave a family a certain amount of money that wasn't taxed, and it was based on family size because there was one exemption for each taxpayer plus each dependent. So, for example, in 2017, that amount was $4,050 per person. Will it come back in 2026? Well, we don't know, because when TICJA reduced the personal exemption to zero, it also increased the standard deduction significantly. And that allowed a household amount of money rather than a per person amount of money that was not taxable, that first amount of money that isn't taxable. I'm not going to talk more about personal exemptions. I just wanted you to know what they are. There are also credits and prepayments that we'll get to at the very end of the video very briefly. We're going to spend some time on standard or itemized deductions as well. So, qualified business income. It is applicable to tax years from 2018 to 2025, but then, like so many of the provisions in TICJA, it will go away if not renewed by Congress. This deduction allows 20% of qualified business income to be deducted from AGI. The reason for this deduction is that TICJA also reduced corporate tax rates dramatically. Corporate tax rates were reduced to make us more competitive with other countries. However, by reducing the corporate tax rates, sole proprietors, S corporations, and partnerships were suddenly subject to the highest marginal individual tax rates, which were well above corporate tax rates. This created a disincentive for those types of entities. The qualified business income deduction was put into place to form a level of equity between the different organizational structures. This is limited based on your filing status and taxable income, and businesses may be limited by the amount of W-2 wages paid and their basis in qualified property. And the income that is qualified business income has to be connected to a U.S. trade or business. So certain income is never considered qualified business income. That includes your capital gains and losses, dividends, and the like, interest, unless for some reason it's allocable to a qualified trade or business. Same thing with annuities. And then wages or salary received from an S corporation employee that is also a shareholder of that same S corporation. This legislation was never intended to cover service professionals. But there's an exception written into the code for specified service, trade, or businesses called SSTBs. If you're not a high-income taxpayer, then you can still deduct 20% of the qualified business income from specific services, including health, law, accounting, actuaries, performing arts, consulting, athletics, etc. Any trade or business where the principal asset of that business is the reputation or skill of an employee is covered under SSTBs. Like so many tax provisions, there are phase-outs. We have a floor and a ceiling depending on your filing status, and this affects SSTBs, but it also can affect other businesses as well. So, for example, if a single taxpayer makes less than $191,950, there is no phase out. If they make more than $241,950, they cannot take the deduction at all. And if they fall somewhere in the middle, then there is going to be a partial phase out of the QBI deduction allowed. These amounts are indexed for inflation, so you need to check and make sure that you know which year you are working on and what the thresholds are for that particular year. So how do we calculate the QBI? Well, the IRS has provided two forms to calculate the QBI on. Form 8995 if you are not over the floor in the phase-out range, and some specific if you are not a specified agricultural or horticultural cooperative. And then if you have over that floor, you need to use the 8995A. I strongly recommend also downloading the instructions to those forms and read the instructions carefully, because there are things that you have to do to adjust that adjusted gross income. So let's work through some examples. Caleb has $150,000 of AGI. All of it is QBI. He is single. He has $20,000 of itemized deductions. What is his taxable income? So we want to start with his adjusted gross income of $150,000. And we know that all $150,000 is QBI, but the deduction is limited to 20% of the QBI or 20% of AGI, whichever is lower. If there's no profession given and it isn't noted otherwise, you can assume that this is not an SSTB. So the default will be that it is some other business, retail, whatever. We're going to subtract from adjusted gross income the itemized deductions of $20,000, giving us taxable income before QBI of $130,000. Now the QBI deduction is going to be 20% of the lower of taxable income before QBI, or QBI. In this case, it's the $130,000. 20% of that is $26,000, and when we subtract that out, we get taxable income of $104,000. Moving forward to another example, Eric is an attorney, married, files a joint return. His business income was $250,000. His wife had income from employment of $70,000. They have itemized deductions of $40,000. What is the QBI deduction? In this case, their adjusted gross income is $320,000, and I am simplifying this. I am not looking at self-employment income. I am not looking at health insurance, for example. So there are other things that you may have to adjust this income by. Make sure you read those instructions. AGI, $320,000. Itemized deductions, $40,000. Taxable income before QBI is $280,000. Does not exceed the floor for a married couple. They're going to take a QBI deduction of the lower of qualified business income or taxable income before QBI. In this case, the qualified business income was $250,000. 20% is $50,000. Taxable income is $230,000. Another example. Sophia is a single CPA who is a partner in a CPA firm. Her share of the partnership income is $700,000. Her taxable income before QBI is $1 million. What is her QBI deduction? Well, she's over the ceiling for a single person, and because her income is from an SSTB, in other words, the income is from the talents or personal efforts of the owners of that entity, she cannot take a QBI deduction at all. If she had had a lower income, then she might have been able to take a partial or a full QBI deduction. But since she's over that cap and her income is from an SSTB, she cannot take any QBI deduction. Okay, that wraps up our discussion of QBI. As usual, if you have any questions, get a hold of me, and I'll see you next time.